Welcome to the deep dive. Today we have a really clear and I think ambitious mission.
I think so.
We're taking a stack of financial sources, specifically these 12 slides that lay out the whole architecture of the stock market.
Right.
And we're going to turn them from just, dense information into foundational, confident knowledge.
We really want to go beyond the simple definitions here. The goal is to uncover the mechanics, the risks.
And a real actionable strategy you can use.
Exactly. We build this deep dive for you, the learner, to make sure this whole complex world of finance is presented clearly without all the jargon that usually scares people away.
Yeah, that jargon is a huge barrier.
It is. So we're going to connect the dots from, historical necessity all the way to modern wealth generation, making sure every critical concept is really analyzed.
Absolutely. We're aiming for the why and the how, not just the what. And to do that, we have to start by looking back. Because the origin story of the stock market is frankly way more captivating than most people realize. Let's unpack this history first, because it's not what you'd expect.
Not at all.
When you think of a stock market, you picture, glowing screens and ticker tapes, right?
Yeah, a trading floor, lots of noise.
But the real beginning, the genesis, it wasn't a bank, it was a shipping port.
In the 17th century, we're talking about the Dutch East India Company.
And what's so fascinating here, I think, is just understanding the context of that time.
Oh, absolutely. I mean, global trade in the 1600s was incredibly lucrative.
Hugely.
But it was also astronomically expensive and dangerously high risk.
You're talking about these massive ventures, right?
Yeah.
Shipping gold, porcelain.
And especially those valuable spices like pepper and cinnamon across vast oceans. It required building huge ships, hiring enormous crews.
Managing supply lines that literally stretched across the globe.
The initial amount of money needed, the capital, it was just enormous.
And this is the critical part. The risk for the early investors was completely non-diversifiable.
What do you mean by that?
Well, if a single storm hit or a band of pirates, privateers, sank the ship,
Right.
the wealthy noble who funded the whole thing was, instantly wiped out.
So it was all or nothing on a single voyage.
Exactly. Massive risk and massive capital needs.
And that systemic risk created a kind of economic bottleneck. The Dutch East India Company, or the VOC.
The Verenigde Oostindische Company, if we want to get formal.
Right. They needed a way to raise way more money than any single wealthy person could provide.
And they needed a way to spread that risk out.
Widely, yes.
Uh-huh.
So they invented what we now recognize as the first joint stock company.
And the real innovation wasn't just about raising the money, was it? It was also about the concept of permanent.
And limited liability. Those two things were key.
Okay, let's break that down.
Well, previously, investors would fund just a single voyage. One trip. If it failed, they lost everything. But if it succeeded, the company was dissolved and the profits were handed out.
So you'd have to start all over again for the next one.
Precisely. The VOC introduced this revolutionary idea, selling permanent shares in the company itself, not just a single trip.
Okay, so that gave them continuous capital.
Continuous capital. So instead of owning a piece of that one ship bringing back cinnamon,
You now owned a fraction of the entire enterprise.
all their ships, all their forts, all their future voyages, you owned a piece of the whole machine.
And that fraction came with this powerful idea of limited liability.
Yes. This is so important. It meant that if the company went bankrupt, the investor only lost the money they put in.
Their personal assets were safe.
Totally protected. Their house, their other wealth, all of it was off the table.
That's a massive reduction in personal risk.
Huge. And it encouraged far more ordinary private citizens to participate. So selling those shares, right there in the shipping ports and coffee houses.
That was the birth of the stock exchange.
That was it. Driven purely by this need for collective enterprise and for risk diffusion.
And that core idea, that thread of collective enterprise and spreading out the risk, that's what we need to hold on to, because it perfectly explains the market we have today.
It really does. If you can get your head around owning a tiny, non-dissolvable fraction of that 17th century shipping giant,
Right.
then you already understand what a stock is today. A stock or a share, it's just a financial instrument.
It just signifies ownership in a company.
Exactly. Buying a stock means owning a portion of that business, its assets, and, its future potential to make money.
I think we often treat stocks like, I don't know, like lottery tickets or some kind of abstract token, but they're tangible claims on actual productivity. When you buy a share, you're buying a tiny fractional claim on everything that company does.
From its factories to its patents to its brand.
Everything. And the value proposition is still so simple and direct.
It is. If the value of the underlying company goes up, maybe its earnings or its growth potential,
then the value of your stock goes up.
if the company is profitable and it expands, you, as the shareholder, you benefit directly.
The sources have a great little example, even though it's scaled down. It's about Amazon.
Right, the hypothetical Amazon.
If a hypothetical Amazon had only 1,000 shares in total and you bought one,
You would literally own one-thousandth of that entire global operation.
it really helps to contextualize the sheer scale of modern corporate ownership.
It does.
Yeah.
But we should dive a little deeper into the structure of that ownership because, as you mentioned, not all shares are created equal.
Ah, okay. The sources distinguish between common shares and preferred shares.
And that distinction is really crucial for understanding why different people invest.
Okay, let's unpack that. Why would a company issue two types? And why would an investor pick one over the other?
So common shares are the standard. They're the ones most people trade.
They're the default.
They're the default. And their main feature is that they come with voting rights.
Voting rights. What does that mean in practice?
As a common shareholder, you get a say in how the company is run. It might be a tiny, minuscule say, given there are millions of shares.
Sure.
But you can vote on things like electing the board of directors or approving a big merger.
So common shareholders are the owners who actually have the power to influence the management.
Precisely. Now, preferred shares, they operate differently.
Okay.
They typically sacrifice those voting rights. So no direct say in governance.
So why would you want that? What do you get in return?
You get preference, especially when it comes to dividends.
Preference and dividends. How does that translate to a real advantage for an investor?
Well, if a company decides to pay out a portion of its profits to shareholders, that's a dividend, the preferred shareholders get paid first
Before the common shareholders get anything?
before they see a dime. And what's more, preferred dividends are often a fixed amount, and they can be cumulative.
Cumulative.
I mean,
Right.
if the company misses a payment one quarter, they have to make it up to you later before paying anyone else.
I see. So it's more stable, more predictable.
Exactly. It makes them less volatile and much more appealing to, say, income-focused investors. Think of pension funds. They prioritize stable, predictable payments over, aggressive growth or having direct control.
That makes perfect sense. So common stock is for the investor who wants growth and a say in the company.
You're right.
And preferred stock is for the investor who wants stability and income. It's about choosing what kind of relationship you want with the business.
Right. And that leads to the next logical step. If a company is, wildly successful privately.
Like an innovative startup or a family business that's just exploding.
Exactly. They eventually hit a scaling limit. They exhaust the capital they can get from private sources, like venture capitalists.
And to get to that next level of exponential growth building factories, expanding globally, funding billion-dollar research.
They need a colossal injection of capital, just a huge amount of money.
And that need is what drives them to the public market.
Which brings us to the initial public offering, the IPO. This is that huge financial event, the moment a company transitions from being privately held to publicly traded.
It gets its shares listed on an exchange like the New York Stock Exchange or the NSE and BSE in India.
And we need to spend some real time on this process because it's complex and it's very highly regulated.
The sources break it down into 4 steps, but it feels like the real depth is in who the players are.
Absolutely. So let's walk through those initial steps.
Okay, the preparation.
Step 1. The private company, which has already shown impressive growth and future potential, starts to advertise itself.
Not on billboards, I'm guessing?
No. To major institutional investors and crucially to investment banks. They're pitching their vision for how they're going to be profitable.
Then step 2 is where the real capital magic happens. If these big investment banks, the underwriters, believe in the company, they sponsor the IPO.
And we should clarify what underwriting means here.
Yeah, what is that?
It's the critical de-risking mechanism for the company going public. The underwriter, which is usually a powerful bank, effectively guarantees the sale of a certain number of shares at a certain price.
So they're taking on the risk.
They absorb the risk.
Yeah.
If the public doesn't buy all the shares at the IPO price, the bank has to buy them.
Wow. So the company gets its money no matter what?
The company is guaranteed the capital it needs, and in the weeks and months before the IPO, that bank goes on roadshows,
Pitching the stock.
pitching the stock to huge mutual funds and wealthy clients to build up hype, gauge demand, and set that initial price.
So the underwriter is like a financial bodyguard. They take the initial hit, and in return they get, I assume, substantial fees.
Substantial fees and control over the launch, precisely, which leads right into step 3, the actual IPO launch.
The company goes live on the stock exchange.
And this is where that price they set during the roadshow gets tested against the real open market. And this moment can be incredibly volatile.
Right. If the price was too low, you get that famous IPO pop.
The price shoots up dramatically. But if they priced it too high, it really struggles to gain any momentum.
And once it's listed, we hit step 4.
The democratization of ownership. Now, any individual with a trading account, including you, the listener, can buy and sell that company's stock.
If we tie this back to the bigger picture, the IPO is just the modern version of the Dutch East India Company gathering up capital from lots of people.
It is. But because it's public, it comes with this immense regulatory scrutiny.
You have to report your earnings every quarter.
Conform to strict accounting standards, answer to millions of shareholders, not just a few private owners.
That transparency is a huge benefit for us, for investors, but it must be a burden on the company.
It is. But it's the ultimate evolution of that idea of collective enterprise, a highly structured system for funding massive corporate growth.
Okay, so we know what a share is and we know how it gets onto the market. But once it's trading, its price is just. It's in constant flux. Why?
This is the point where the incredibly complex world of finance meets the shockingly simple rules of a marketplace.
It all comes down to something basic.
It does. The core principle is universal. It applies to a used bicycle on Craigslist just as much as it applies to a share of Apple.
Simple supply and demand.
That's it. The stock market isn't some, thinking entity. It's just a reflection of millions of independent traders deciding in real time if a stock is worth buying or selling at its current price.
Let's stick with that Craigslist analogy because it's so relatable.
It's perfect.
If you're selling something for, say, $100 and you immediately get a dozen offers, what's the obvious conclusion?
The demand is high and the supply of your one item is low. You instantly realize you priced it too low.
So you raise the price.
You raise the price maybe a few times until the demand starts to balance out with that new higher price. That's high demand driving the price up.
And the reverse is true. If you list that item for $100 and it just sits there for weeks, crickets.
Then you have high supply relative to the demand. So you have to drop the price.
You keep dropping it, 90, 80.
Until you hit a level where a buyer believes it's worth the cost. Low demand or just too many sellers forces the price down.
So how does that simple idea translate into the stock market, where prices are moving every second?
It all happens through something called the order book. When you place a trade, you're placing either a bid,
a price you're willing to buy at,
or an ask, a price you're willing to sell at.
Okay.
Now, if there are far more people placing buy orders, that's demand, then there are people placing sell orders at the current price.
The system runs out of sellers at that low price.
It runs out. So the buyers are forced to move up to the next highest price point to get the shares they want.
And the price just ratchets up bit by bit.
Continuously. That ticker tape movement, that famous up and down motion, it's just the visible result of that constant tug of war between all the buyers and all the sellers.
And what fuels that interest? What makes more people want to buy or sell at any given moment?
Information.
Yep.
Or even just the perception of information. A great earnings report comes out, a new competitor emerges, a surprise product announcement.
All of that instantly shifts the collective mood.
It shifts the demand. It overwhelms one side of that order book and causes the price to adjust, sometimes rapidly, until a new balance is found. It's a mechanical process, but it's driven by our collective human interpretation of news.
So that brings us to the core question, really. Why? Why expose your money to this volatile system at all?
Right. Why not just keep your money safe in a traditional bank savings account?
Exactly.
And the answer lies in the fundamental difference between saving and investing.
Okay.
A typical high-yield savings account might earn you, let's be generous, maybe 2 or 3% per year.
Which feels safe.
It is safe.
Oh.
But that rate often barely keeps pace with inflation. Sometimes it even falls behind.
So your money is holding its nominal value, but its purchasing power might actually be going down.
It stagnates.
Yeah.
And this is where we need to talk about the concept of real return.
Okay, what's that?
If inflation is, say, 3%, and your bank is also paying you 3%, Your real return is zero.
You're just running to stay in the same place.
You're on a financial treadmill. The stock market, on the other hand, offers the potential for significant real inflation-beating growth.
Because you're investing in actual productive businesses that are expanding.
You're participating in economic growth, which historically outpaces inflation by a significant margin over the long term.
The sources highlight this potential with that famous Amazon example.
An extreme example, but a powerful one.
If you had invested $1,000 in Amazon stock back in 1997,
That $1,000, because the power of compounding returns on a massively successful company,
would be worth roughly $1.5 million today.
it's an incredible number. And while, that's an outlier, it perfectly illustrates the engine of wealth creation that the market can be when growth is sustained over time.
And that massive jump, it really crystallizes the potential. But you don't need a 100-fold return to justify taking the risk.
Not at all.
The sources note that many established companies provide yearly returns in the, 30 to 70% range.
Which significantly outstrips that 3% benchmark from the bank.
So even if you don't find the next Amazon,
You're still doing much better than just letting your money sit there. And if we look at the historical average of a broad market index, like the S&P 500, over the last century.
which tracks the biggest 500 companies in the US,
Right. The annualized return is closer to 10%.
10% a year on average.
Even that 10% compounded over decades is absolutely transformative. It shifts your financial position from just maintaining value to actively growing your wealth. You're harnessing the economic power of corporate innovation
The goal is to put your capital to work.
to let it compound for the long term.
Right.
But we have to temper that excitement about growth with a pretty harsh reality check.
Okay.
The stock market is a two-edged sword, and the vast majority of people who try to actively trade, they lose money.
And the sources are very clear about why this happens.
It's a common failure. People jump in without learning the rules, without understanding the instruments, and without appreciating the inherent risks.
So if you act without that foundational knowledge, the probability of a painful loss is just extremely high.
Which leads to the source's most critical lesson,
Yeah.
one that you hear repeated all the time in financial circles.
Learn before you earn.
Learn before you earn. A lack of knowledge, especially when you combine it with high-risk practices like using leverage, can be absolutely devastating. And the anecdote in the slides illustrates this perfectly,
This is the cautionary tale. It involves a father trading commodities.
which is already a very complex and volatile corner of the market.
And the specific detail noted is that he didn't understand the fundamentals. He didn't even know basic technical indicators like candlesticks.
For a technical trader, a candlestick is like the visual language of the market.
What does it show you?
It shows you 4 key pieces of price information in a single period: the opening price, the closing price, and the highest and lowest prices reached during that time.
So not knowing how to read those is like,
It's like trying to drive without understanding what traffic lights mean. He was flying completely blind to what the market was doing in the moment.
and even more dangerously, he was using leverage. We really need to unpack that term because it is the primary engine of spectacular failure.
It is. Leverage is, in essence, borrowing money to increase your purchasing power.
So you're trading with more money than you actually have.
Exactly. Let's use a concrete example. Imagine you want to buy $100,000 worth of stock, but you only put in $10,000 of your own cash.
Okay.
The broker lends you the other $90,000. You're trading with 10-to-1 leverage.
So what's the risk there? The upside seems obvious.
Well, the upside is if the stock goes up 10%, you've made $10,000 profit on your $10,000 investment. That's 100% return. That's the allure.
That's the hook.
But if the stock drops just 10%, just $10,000 in value,
You lost all of your original $10,000.
your capital is completely gone. In fact, you get what's called a margin call, where the broker demands you deposit more cash immediately to cover the loan.
Before they just sell your entire position for you.
Right. And in this anecdote, the result of that recklessness was a devastating loss. 10 lakhs in one night,
For our global audience, 10 lakhs is about 12,000 US dollars.
which is a massive amount of unexpected debt, especially when it comes from speculation. The loss was so severe that he had to take out a loan just to cover the trading debt.
It turned a theoretical risk into a concrete, life-altering financial disaster.
The lesson is just undeniable. The market will ruthlessly punish recklessness and a misunderstanding of basic instruments like leverage.
That story really emphasizes that risk isn't just about picking the wrong company.
No, not at all.
Even if you pick a winner, there are mechanical trading costs and hidden frictions that can just eat up your profit.
Which is why we have to talk about these often invisible costs.
Yeah.
The spread and liquidity.
Okay, let's start with the spread.
These two concepts are deeply connected. They represent the transactional friction of the market. The spread is the difference between the highest price a buyer is willing to pay
That's the BID,
and the lowest price a seller is willing to accept.
the ASK.
Right. So if the highest buyer is bidding $10 and the lowest seller is asking $10.05,
That 5-cent gap is the spread.
that's the spread. And if you place a market order, which means you want to buy or sell immediately at the best available price, you are forced to cross that spread.
What does that mean, cross the spread?
As a buyer, you have to pay the higher ask price, $10.05. But the moment you own it, the best price you can instantly sell it back for is the lower bid price, $10.
So you're instantly 5 cents underwater.
Instantly. That spread is the transaction cost, and it's often collected by the market maker or the broker.
Okay, so if the spread is the gap, where does liquidity fit in?
Liquidity is the measure of how easily and quickly you can buy or sell a stock without significantly affecting its price.
So high liquidity is good?
High liquidity is very good. It means there are millions of buyers and sellers placing bids and asks very, very close to each other.
Which results in a tiny spread.
Maybe just a penny. But if liquidity is low,
That gap gets much wider.
it can widen dramatically. And the sources give a perfect real-world example of this danger. It's a trader who was in profit on Havel's stock options.
Okay, so on paper, he was making money. The price had moved his way.
He had a paper gain, yes.
Oh.
But when he executed a market order to sell immediately and lock in that profit, his position closed at a loss.
Wait, how does that happen if the stock price was up?
Because in that specific moment, for that specific option, there were very few buyers.
Low liquidity.
Very low liquidity. The only available buyer left on the order book was bidding a much, much lower price, maybe $5 below the last traded price.
Wow.
So that large gap between what he thought the market price was and the low bid he actually received when he sold.
It ate up all his profit and then some.
Exactly. It turned his paper profit into a realized loss.
This just highlights how important it is to understand how you place your orders.
Absolutely. A market order in a low liquidity stock is exposing you to the whims of that spread.
So what's the alternative?
A savvy investor, especially with options or less traded stocks, should use a limit order.
Where you specify the exact price you're willing to accept.
The exact price you're willing to buy or sell at. It protects you from those predatory spreads, even if it means your trade might not execute right away. Understanding spread and liquidity is just crucial knowledge before you place your first trade.
All right, so we've covered the history, the mechanics, the allure, and some very, very real risks. For the listener who's ready to move forward, getting started is more accessible than it's ever been.
It really is.
But it requires these 3 structured steps.
Step 1, you absolutely must open a trading and demat account. This is your legal, technological gateway to the market.
And a demat account or dematerialized account, which is standard in places like India.
No, what does it do? It serves 2 functions. It holds your financial securities, like stocks, digitally, and the trading part of the account is what lets you actually execute buy and sell orders.
And you can open these accounts through your traditional bank or...
Increasingly through modern low-fee tech companies, discount brokers. They often offer much better pricing.
The key is just to choose a reliable, regulated broker that's appropriate for your local exchange, whether that's in New York or India or anywhere else.
Then you get to step 2, which is the investor's primary defense.
Do your research.
Do your research. The sources stress this by equating it to a major life decision. You have to understand how the company actually makes its money.
Where its competitive advantages, its moat.
And its financial standing. You have to check that before you commit your capital.
And that research is comprehensive. It's not just reading news headlines.
No, it means analyzing financial ratios. What's the PE ratio, the price to earnings? How healthy is the balance sheet? Who's on the leadership team? Is the whole industry growing or shrinking?
If we tie this back, you're not gambling. You're becoming a fractional business owner.
And you wouldn't buy a house just based on a colorful ad, would you?
No, you'd hire an inspector, you'd review all the documents.
Your hard-earned money deserves that same level of scrutiny.
And finally, step 3, which is all about managing the emotional risk.
Start with money you can afford to lose.
This cannot be overstated.
It really can't. Never, ever invest money that you rely on for rent, for bills, for your immediate survival.
Why is starting small so important?
Because it lets you learn the mechanics in a low-stakes way.
Yeah.
You can feel the emotional pressures of the market. You can make the inevitable mistakes, like getting hit by a bad spread.
Without risking the kind of financial ruin we saw in that cautionary tale.
Exactly. Invest wisely, start small, and let your education drive how you deploy your capital.
So you've done the research, you've opened your account, you have some capital ready to go,
Yeah.
and now you're staring at this massive screen listing thousands and thousands of companies. This is the investor's dilemma.
It is. How do you responsibly narrow down that field?
How do you choose?
And this is where we have to be honest about what investing in individual stocks, what's known as active management, really requires.
It's an almost unbelievable commitment of time and resources for the average person.
We really underestimate what genuine due diligence involves.
It demands extensive, continuous research. You have to constantly analyze complex financial reports. You have to assess the quality of the management team.
Which is a very subjective judgment call.
And you have to understand all the macro forces, inflation, interest rates, geopolitics that affect your specific industry.
It's a part-time job, at a minimum.
And it demands constant monitoring. The news flow for a single company is relentless.
Management changes, new lawsuits, a competitor's breakthrough product.
A single event can radically change the value of your investment literally overnight.
And on top of all that, to manage your risk responsibly, you need diversification.
You can't put all your eggs in one basket.
The sources suggest that to be truly diversified and safe from one company's disaster, you need to hold 10 to 20 different stocks,
Across various sectors.
which just exponentially multiplies the time and the capital you need.
And this burden, this high commitment of active management, it raises a really profound question. The source material calls it the conviction test.
Right. If you find a stock that you believe is going to be the next massive winner, the question you should ask yourself is, would you sell your house and invest all your money in it?
Now, that's a provocative question. It's obviously designed to shock the casual investor.
It is.
But it's hyperbole, right? No one is actually suggesting I sell my house.
It was absolutely hyperbole.
Okay.
But it serves a critical psychological function.
How so?
It highlights the huge difference between thinking a stock is, pretty good versus having the deep, absolute, comprehensive conviction that comes from truly knowing everything about that company's future.
And most people, most individual investors, lack that kind of all-consuming conviction.
Because achieving it requires professional level, full-time research.
So if you can't look at a company and, at least in theory, bet your entire financial existence on it after your analysis.
Then maybe the effort required for picking individual stocks is misdirected for the average investor.
It suggests that unless you're ready to make investing your second full-time job, the high cost of diversification, monitoring, and research makes it a pretty inefficient and high-risk strategy for long-term wealth building. That high barrier to entry for individual stock picking, the need for all those stocks and constant research, it suggests we need a simpler, smarter path.
A path that still captures that 10% average growth potential we talked about earlier.
Right, and this is where we pivot from high-stress active management
To low-stress passive market participation. This leads us directly to the exchange-traded fund, or ETF.
Okay, let's unpack this in depth. What exactly is an ETF, and how does it solve that big diversification problem?
An ETF is essentially a single investment that holds a basket of many different company stocks all at once.
Like a prepackaged portfolio.
A prepackaged, professionally diversified portfolio. Instead of you having to go out and buy Amazon and Google and Apple individually,
Which would take a lot of money.
a lot of money. You just buy one single unit of the ETF, and that one unit gives you fractional ownership in all of those companies simultaneously.
It sounds like a mutual fund.
It acts like a mutual fund, but critically, it trades on the stock exchange all day long, just like a single share of stock.
So that is instant, efficient diversification. It addresses the main hurdle from the last slide.
It's instant diversification.
Yeah.
And we need to understand how that basket is put together. And the most popular ETFs simply track major national indices,
So you can buy an ETF that tracks the Nifty 50 in India,
which is India's 50 largest companies,
or one that tracks the S&P 500.
America's 500 largest companies.
The S&P 500 is a crucial concept here. It's a market cap weighted index. What does that mean for me as an investor?
Market capitalization is just a company's total value. You take the share price and multiply it by the number of shares out there. In a market cap weighted index like the S&P 500, the biggest companies like Apple and Microsoft make up a proportionally larger chunk of the ETF.
So if Apple makes up, say, 7% of the total value of all 500 companies.
Though when you buy that ETF, 7% of your money automatically goes into Apple.
So you are, by definition, betting more heavily on the companies that have already proven to be the most successful.
Exactly. You are inherently biasing your investment towards the proven winners. With one single purchase, you become invested in the largest, most successful, and most diversified parts of that entire national economy.
You're no longer betting on the CEO of one spice ship.
You're betting on the enduring collective growth of the entire country's corporate landscape.
And that strategy, it shifts the emotional burden completely, doesn't it?
Completely.
You move from that high-stakes pressure of picking the right stock to a confident long-term strategy.
Because your conviction isn't resting on a single management team anymore. It's resting on the macro growth of an entire country or even the global market.
What's fascinating to me here is the cost efficiency and the behavioral advantage this gives you.
Let's lay out the key differences. Individual stocks versus these market ETFs.
Okay, so individual stock investing is defined by the need for active monitoring, constant research,
High concentration risk in one or two names.
and a really high susceptibility to emotional decisions, buying into the hype or panic selling during a dip.
Market ETFs just completely flip that script. They are passive. They require minimal personal research beyond just understanding the index you're tracking,
They are automatically diversified by design.
which smooths out the inevitable failures of a few of the companies inside the basket. And crucially, they offer a massive cost advantage.
The cost advantage is a huge insight that people often overlook.
Yeah.
Professional mutual funds or stock picking services, they can charge high fees.
Sometimes 1 or 2% every year.
How do ETFs compare to that?
ETFs, especially the ones that track these broad market indexes, have incredibly low expense ratios.
How low?
Sometimes as low as 0.03%.
Wow, that's almost nothing.
That difference might sound small, but when you compound that over 30 years, the fees you save drastically improve your net return. You are paying practically nothing to bet on the entire economy.
So what does this all mean for the listener's peace of mind?
It means you can invest regularly and systematically, maybe every single month, into a broad index ETF, and then genuinely get on with your life.
You don't have to worry about the daily noise of one company's news or some management blunder.
You just know that if the country's overall economy continues its multi-decade growth trend, your money will grow right along with it.
It's a highly effective, low-stress strategy for achieving that long-term compounding. We've taken the listener on a journey from the 17th century invention of risk diffusion all the way to a modern, disciplined investment strategy.
It's a lot of ground to cover.
So let's review the 4 pillars of knowledge that our source material provides, just to solidify that foundation.
Okay, pillar 1. The stock market is fundamentally a tool for growth.
Its historical origin was about gathering up capital for a collective enterprise.
And that is still its primary function today, funding successful businesses and allowing individuals like us to participate in their prosperity.
Pillar 2, mechanics matter.
At its core, prices are just driven by simple, constant competition between buyers and sellers.
Supply and demand.
Understanding how that mechanism works in the order book and how news influences it, that's the key to understanding why prices move.
Then pillar 3, knowledge is your defense.
The market has immense potential, but the risks are significant and they are often hidden.
Like the dangers of leverage and that transactional fiction of the spread and liquidity.
Learning the fundamentals is your best protection against making unnecessary, reckless losses.
And finally, pillar 4, a smarter path.
You don't need to dedicate your entire life to financial analysis to be a successful investor.
For a confident, reliable, long-term approach, that passive strategy using broad market ETFs offers.
Instant diversification, low cost, and allows you to bet on macroeconomic success rather than the volatility of a single stock.
That whole view, moving from the historical context to risk analysis and then to an actionable strategy, that's what turns passive curiosity into real capability.
It is. We've shown you that the biggest risk is often just doing nothing. It's the opportunity cost of keeping your money on the sidelines.
The first step is getting invested.
And with the comprehensive knowledge we've covered today, you have now a foundational understanding of how the market works, the risks involved, and a powerful strategy to begin your journey with confidence.